But it's the current pullback which has seen the mid and small cap indexes fall sizably from their all-time highs. However, for the year, India is still standing tall when compared to the MSCI Emerging Market Index. What could the uncertainties that the market is staring at mean for the next course of the market? Pankaj joins in with a quick analysis.
Well, Harsha, as you said, let's just take a stack of what's happened in the market and how things have happened so far. So from the all-time high, you can see Nifty is down 4.5%, which is not a meaningful cut. The mid-cap index is down about 18% and the small-cap index is down 26%. This is from the all-time high. Just in the month of June, if you would take it, it would, majority of the cut would have come in the month of May as well as June. So that's broadly what you're seeing into the mid-cap and the small-cap side of the market. Now, this is coming with flows not looking that great. You have FIIs, which have pulled out about $1 billion. You have DIIs, which have been continuously investing. Now, if I look at the Indian markets on a YTD basis, I compare it to developed market like S&P 500, completely in line. You look at the MSCI emerging markets, it includes the likes of Brazil, Russia, which has extensively fallen, and that's why you're seeing that Nifty is still outperforming the MSCI emerging markets. But from now, till about last 3 months, there is a lot of uncertainty which has built up into the market. So firstly, higher crude oil prices are sustaining. We all know that crude oil prices or higher crude oil prices has a twin deficit issue as far as India is concerned, and that is one of the key worries. What happens in terms of trade war, the noises around trade war, how it is happening is leading to a risk aversion globally. India is a big FII market. FIIs own a significant chunk in India, ex the promoters, and that's why, it's leading to outflows, and that's also taking things higher. As we go into 2019, there are the big, elections which are lined up, and markets are, going into that uncertainty. What will happen? How will happen? Again, most of the strategists that we speak to still say that, political news is not factored in, but that is something which has happened. We spoke about risk aversion. This is the SEBI or the NSDL data that we are referring to. $1 billion in the secondary market. Already you have about $6 billion in terms of sale from FII. So all these, continue to be the big worry for the markets. Apart from that, earnings are coming in either in line or slightly lower on a consensus basis, and that's why you're not getting overall earnings upgrade also, which could prompt to some sort of buying. Apart from that, there are a lot of news flow regarding ASM, what's happening with NPA, how NPA situation is looking. So all of these things don't really augur quite well or create some uncertainty if you're a long-term buyer.
Okay, so I'll take that conversation forward. I guess, Pankaj has made a base for what we are likely to discuss with Harsha. Harsha, when the year started, the smart guys said, look, 2018, hunker down your expectations. This is not going to be 2017 or repeat of 2017. But I don't think anybody saw this kind of an gut-wrenching fall in mid-cap and small-cap was coming. 5, 10, 15% maximum was the kind of sense which I got from old-timers. They said, look, market kharab lag raha hai, 15-20% gir sakta hai. But now if I look at the carnage, it is 30 to 50% on an average.
Good morning, Nikunj. Yes, that's right. I think, whenever the pendulum swings, it swings to the extreme. And we have seen complete risk aversion in mid and small caps. As you rightly mentioned, more than 2/3 of the stocks in the universe have fallen more than 20%. The median fall in the top 1,500 companies is more than 30% year to date. So that clearly shows the kind of nervousness that's there in the market. And part of it is also because of the fact that in 2017, the returns were very, very, very significant, especially for mid caps and small caps. It was a one-way street without any volatility. So a lot of money has flowed into mid and small caps, which had raised valuations there. And with this nervousness, that correction is becoming significant. And we really don't know whether the entire correction in the mid caps is over or not. Our belief is maybe there is one more round of correction which is still out there.
One more round of correction which is still there. You're scaring me.
See, when you look at the market, you look at the main indices, whether it's Nifty or Sensex, they haven't really shown any kind of fall. 3 to 4% fall is generally kind of a correction in a bull market, whereas mid and small caps have shown significant correction. So what if the mainline index starts to correct, let's say more than 5%, then there could be another round of fall in mid and small caps. That's what we fear.
Right. But Harsha, how meaningful could the next wave of decline be, considering we've already fallen about 26% on the small cap index from the all-time high?
That's a good point. I think I mean, if you look at last 6 months, while large cap index remained more or less stable, we have seen a significant correction in mid and small caps. So maybe not to that same extent you will see in the next leg of correction. But still, when the main index falls, so we could expect some more correction in mid and small caps. But that could be a buying opportunity on a stock specific basis.
Cash, because if you're calling for a correction, I'm sure you would like to protect capital. So are you sitting on cash which is much higher than your historical levels? And at what level you would say that, look, I'm happy to put that cash to work?
Nikunj, we generally do not take cash calls because that's a double-edged sword. When the markets move sharply on the other side, do you get left out? So to that extent, as a policy, we don't hold more than 7.5% in any of our equity schemes. Currently, we are running at about anywhere between 3 to 6% in most of the portfolios. Cash generally do not give you a kind of resilience in terms of managing the NAV, but it does give you optionality in terms of entering some of the stocks where there has been significant correction, and that's what we are looking at. We would be looking at investing this cash in the next leg of correction.
But Harsha, what is it that you would hunt when that next wave of correction really comes in? I'm sure you're deploying this time in the sidelines to chalk out that list and pockets which are looking interesting to you.
It's been very, very stock specific. We are looking at two kinds of stocks. One, where there has been some negative news or negative development and the stock has fallen sharply. And if that correction has been more than what the fundamentals warrant, then that becomes a buy for us. And secondly, there are many steady growth companies which were generally trading at, let's say, for example, at around a certain level of price to earnings multiple or price to book multiple. That has got elevated in the year 2017, and we saw maybe 30-40% higher valuations as compared to average valuations in many cases. And if those set of stocks have seen correction, that means that maybe those are still giving you steady set of earnings numbers, but the valuations have come back to historical averages. So that again becomes a good basket to look at. So it's going to be very, very stock specific. If you ask me right now, we don't have too many names in front of us, but I think we will keep watching and see where there is significant correction more than what the fundamentals warrant and try to deploy some money there.
Is the run up in IT slightly over exaggerated? Yes, growth is coming back, but this is not like some 30-40% growth which is making a comeback. I mean, 7% growth has become 9% growth, or 9% growth at max will become 11% growth. I mean, the way TCS and Infosys have got re-rated, it appears that, okay, there is some TMT boom which has been unleashed.
I tend to agree with your analysis, Nikunj. We also believe that on the IT sector, while the growth numbers have improved, the management commentary has kind of become a little bullish, and there is also buyback to support in some cases. Overall, when you look at some of these companies and compare them to some of the domestic names, on a 3-year basis or a 5-year basis, we still believe some of the domestic names can give you more returns than IT sector. But at this point of time, given the concerns on the overall market, this seems to be a defensive space to be in, and that's where most of the money has moved in the last couple of months. But again, there is a risk if some of the growth numbers don't meet the expectations.
Hearing reports that the PMS schemes are suffering. A lot of mom and pop PMS schemes had popped up because it was a bull market, and we know in bull market everyone finds things that making money is like very easy. Are you getting a sense that there is a lot of pressure which would come in small and mid cap stocks from those small PMS or AQFs which had mushroomed up?
I think we are already seeing some amount of pressure from that basket. Clearly, the kind of fall that we have seen in small caps especially shows that there has been significant selling from some of these entities. Clearly, most of the PMSs focused on small cap, and most of the holdings were very, very concentrated, unlike mutual fund schemes where there is a lot of diversification. So in a declining market, the concentration will obviously work negatively and will adversely impact more than what the market is actually showing. So to that extent, there has been significant erosion in some of the PMSs on the small cap side, and there could be some redemption because of that as well.
Harsha, what according to you would actually, recede this correction in the broader markets and lead to a meaningful rebound? Would it have to be something global? Would it have to be enough price damage and valuation damage on the table? Or would it just have to be a very genuine across the board earnings recovery which will finally snap the markets out of this bleak phase?
Aisha, I think it will be a combination of all of these. I don't know which one is going to happen first. I think clearly there are macro headwinds, mostly from a global perspective. The way the crude has moved up beyond $75 per barrel on the Brent, the way the currencies have been sliding, especially the emerging market currencies, the increases that we have seen on the interest rate cycle. So all of these factors have led to some kind of nervous sentiments, and any of these, if they start to reverse, I think there will be some positive undertone to the market. Similarly, earnings have not been coming through for the last several years. Every year, the analyst expectations have not been met, and this year again we are starting with almost 22% earnings growth expectations for Nifty. So if those numbers are met, or if the market feels that at least in the second half some of those numbers could actually come through, then maybe there will be some positive sentiment to the market. Similarly, I think if there is a large price erosion from here, I think that itself will give some support to the market. So a combination of all of this could really support the market, but at the moment we don't see any of that playing out.
Down another 5%. Matrimony was up 14%, yesterday is down 4%, and 8K miles is down another 13%. So, every week we have these 10, 15, 25 stocks which are called as real casualty stocks. And last week it was Manpasand, it was Vakrangi, before that it was PC Jeweler. I guess the real casualty stock for this week is 8K miles. It really gave you this promise of cloud and high cloud growth. For quarter on quarter, they kept on surprising everybody. Markets got drawn in. Best of the fund managers, they bought the stock, including the likes of DSP, BlackRock, which before the split, and now things have really reversed for 8K miles. Dilip Bilkon, another one. All major brokerages have a buy on them. There was this rumor of corporate governance. The management came out and said, look, all is well with our numbers. The auditors are more than happy to sign the balance sheet, but somehow the wheel has really reversed for some of these road construction companies as well. Harsha, do you think this entire corporate governance issue, which suddenly has cropped up, is slightly overdone? Yes, there are some bad apples, but the way road companies, the way construction companies are falling, it's like saying that market feels that the entire basket is rotten. Are you finding opportunity in some of these names where you think the crucifixion has been slightly unjustified?
See, I don't think one can make a generalization saying that all the small caps or all stocks belonging to a particular sector are bad in terms of corporate governance. I think one has to go deeper and analyze and see how these companies stack up. I would not like to really comment on individual stocks where there have been some issues. I think our portfolios show where our investments are, and I'll leave it at that.
Okay, Harsha, we'll leave it at that as well. Good speaking with you as always. Thanks for joining in.
Thank you, Aisha.
Okay, that's the word coming in from Harsha Upadhyaya, warning that this may not be it. We could see some more correction in the pipeline for the broader end of the market and eventually see a recovery thereby.